This is Nightly Business Report with Sue Herrera and Bill Griffith.
Upping the ante, investors turn cautious and send stocks lower on a report that Washington is ready to escalate trade tensions with China again.
I've been buying stocks since March 11th, 1942.
And he hasn't stopped yet. The Oracle of Omaha says he's buying more, even as the indexes sit at near record levels.
Going for a ride, why Santa Monica is at the center of the battle over the fast-growing scooter business. Those stories and more tonight on Nightly Business Report for Thursday, August 30th. Good evening, everybody, and welcome. I'm Sue Herrera.
And I'm Tyler Matheson, in tonight for Bill Griffith. Well, Wall Street's win streak snapped. The reason, in a word, trade. A report midday said that the president was considering moving ahead with additional tariffs on Chinese imports as early as next week. The tariffs would cover an additional $200 billion worth of goods. That would be on top of the billions already affected. Now, the report added that the president has not yet made a final decision, but no matter, the markets moved. The Dow Industrial Average dropped 137 points to 25,986. The Nasdaq fell 21, even as shares of Amazon closed above 2,000 apiece. And the S&P 500 was down 12. Bob Pisani has more on today's drop.
Stocks drifted lower through much of the morning, but took a dive as trade war fears once again took hold. Now, both stocks and bond yields immediately fell to session lows on a report saying that President Donald Trump says he wants to move ahead with a plan to impose tariffs on $200 billion in Chinese imports. That's not good news for the markets. The problem here is the markets kind of levitated itself into believing that in the long run, there really wouldn't be any truly damaging trade issues on the horizon. But today's headlines show that the president, in fact, is planning to double down and apply even more trade pressure on China. So the Dow fell triple digits, and of course it was led by global industrial names like Boeing and Caterpillar. Those are the names that typically drop on trade war fears. We did see a sudden reversal in momentum names that were pulling the Nasdaq to new highs earlier, so tech names like Apple and Nvidia came off of their highs along with broader semiconductor stocks. And US-based China internet stocks moved lower, so Baidu, Alibaba, JD.com. This always happens when you get trade war fears. They dropped. Emerging market stocks took a turn for the worse. Stocks in countries like Brazil and Mexico, which have been under pressure thanks to rising dollar issues, they dropped even more. Most commodities are priced in dollars, so it has made commodities more expensive to buy in other currencies. And that, along with tariffs on aluminum steel, has hurt metal stocks. It's been a tough time in the last couple of weeks dealing with the trade issues. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Speaking of which, trade talks between the U.S. and Canada have gained some urgency ahead of tomorrow's deadline that's being pushed by Washington. As negotiations intensify, the Canadian foreign minister says she's optimistic.
We continue to be encouraged by the constructive atmosphere that I think both countries are bringing to the table. There is a lot of goodwill. It's a lot that we're trying to do. In a short period of time, we're working very intensely.
Separately, the president threatened to withdraw from the World Trade Organization if it doesn't, quote, shape up. In an interview with Bloomberg, the president criticized the trading group's treatment of the U.S.
The effects of the trade disputes are being closely watched by Warren Buffett. But what does the influential billionaire investor have to say about stocks as they sit near record levels? In a one-on-one interview with Becky Quick, she asked Mr. Buffett if he thinks the market looks expensive.
There's just no question you're going to do better owning stocks. So it's considerably more attractive than fixed income securities. That doesn't mean they're going to go up or down tomorrow or next week or next year. But over time, a bunch of businesses that are earning high returns on capital are going to beat a bond that's fixed at roughly 3% for 30 years. And it's not my field of specialty, but they're American businesses, 30 trillion worth of them, and they look cheaper than generally real estate.
You own 5% of the shares outstanding of Apple. It's the biggest holding for Berkshire Hathaway at $56 billion. Have you continued to buy even since that filing?
We bought just a little. About 6 million of the shares are attributable to another fellow in the office that's owned it for a considerable period of time. The rest are my portfolio, but I bought just a little bit. I like to buy them cheaper. I mean, it's very difficult. I started buying when the stock was maybe 100. And I was buying it kind of as fast as I could, and then I ended up buying some as high, a whole lot higher. I won't name the exact price, but a whole lot higher. I'd rather have it go down. For one thing, if it goes down, Apple's going to buy a lot of stock back. They're already buying stock back. And if it goes down 10%, it means they get to buy 10% more shares, and my interest will go up 10% more for spending that money and buying shares. So I am benefited by going down. If I were to talk my book, I would talk it down.
The economy's firing on all cylinders. One issue that people have worried about is what's happening with trade and tariffs. Have you seen any impact on Berkshire's businesses or higher costs associated with any tariffs that have gone into place?
Yeah, there are a few, definitely. And we buy steel, for example. I mean, at MyTech, or we buy it at a lot of places. And we are seeing some effects from that, and we're seeing some effects from inflation.
I'm sorry, from inflation.
We've seen more in the way of cost increases in the last year, if you go across all of our businesses, but particularly building materials, or we sell paint. I mean, the can it comes in, that is a lot more expensive than it was a year ago.
The interview with Mr. Buffett was done before he joined the winning bidder of his annual charity lunch. The meal with the Oracle went for more than $3 million. The proceeds go to the Glide Foundation, which serves the poor, homeless, or those battling substance abuse. The lunch came on Mr. Buffett's 88th birthday. Happy birthday.
Mm-hmm. Oil prices extended their August climb. The price of domestic crude settled above $70 a barrel, lifted by declines in crude supplies, as well as concerns about supply disruptions out of Iran and also Venezuela. And there are also new reports that Iran is threatening to halt the flow of oil through the Straits of Hormuz, which is the route for 30% of seaborne crude.
John Kilduff joins us now to talk more about Iran, the oil markets, and where he sees prices heading. John? You again, huh?
It's me again, sir.
You again, from again capital, John. I've heard conflicting stories that gasoline prices are going to stay roughly where they are for a while, which is 40 cents a gallon higher than they were at this time last year, or that as we move into September and October, seasonal changes, they may go down. What do you see for the rest of the year?
I think right now this is unfortunately potentially the calm before something of a storm. We are well supplied on gasoline. We are switching over to the winter blend of gasoline that's easier to make, more uniform, more uniformly supplied. So it gathers about a 10 to 15 cent discount just on the barrel versus the summer blends. So between now and say the end of October, prices should stay relatively stable, but you are already seeing them creep up from where they were earlier in the year because of the price of crude oil creeping up and because of just unbelievably strong demand out there. This past week was the highest gasoline demand week all year, greater than even the 4th of July gasoline demand week. Which
explains why I was stuck in traffic, because everybody's on the road.
Everybody had the same idea, Sue.
What about the situation between the U.S. and Iran, specifically as it relates to sanctions and Iran's threats perhaps to close down the Straits of Hormuz? How do you see that playing out and the effect on oil and gas?
Well, everybody's retreating to their corner, getting ready for the fight. And that's the rhetoric that you're seeing from Iran about claiming ownership all of a sudden over the entire strait, which is really split between it and Qatar, very narrow two-lane passageway. But everybody has to play to their home base. So the rhetoric is flying. And when I said a moment ago about this is the calm before something of a storm potentially, that's what I'm referring to. The market is getting tight already. We're seeing major international oil companies already pull back from buying Iranian crude oil so as to avoid running afoul in any way, shape, or form of the reimposition of the U.S. sanctions that come the first week in November.
You've got two major suppliers of oil that are going to, there's Iran on the one hand and there's Venezuela on the other. And that is now a supply squeeze, right?
Absolutely, Tyler. And we can't make it up, really. There's no place. The U.S. is pumping full out. Venezuela is circling the drain. The numbers there, the volumes there are falling much more rapidly than even some of the most aggressive analysis that we had about how quickly they could implode. Their Citgo unit here in the United States is about to potentially be taken over by a creditor from Canada. Believe it or not, that could disrupt things. So everybody's pumping full out. We can't make up these lost uranium barrels.
So those factors point to an oil price later this winter of what?
You know, I'm not here to try to make an outrageous high price claim, but it could go as high as $85 to $90 a barrel. The Northern Hemisphere winter is the peak demand period, not the summer driving season. It's all your winter fuels that are kicking in on top of transportation fuels and the holiday shopping season. That's the squeeze. That's why we could bump up against a very high price and rough winter that way.
John Kilduff of Again Capital. Good to see you again.
Thank you, Sue.
And speaking of Venezuela, could the final blow to the already collapsing economy of Venezuela come not in the streets of Caracas, but in a courtroom in Delaware? Some say it may, because that is where the fate of Venezuela's last great asset, the oil and gas company we just mentioned, Citgo, may be decided within days. Brian Sullivan has the story.
It's part of a decade-long fight with a Canadian hedge fund called Crystalex over a gold mine in Venezuela. In 2008, then-President Hugo Chavez nationalized the mine and gave it to Venezuela's national oil company known as PDVSA. Crystalex sued, saying that Venezuela had no right to steal the mine and demanded repayment. Fast forward to this year, and after a series of agreements and favorable court rulings, PDVSA now owes more than $1 billion to Crystalex.
The U.S. Marshals have served, and we actually have the federal warrant that served PDVSA in the United States. It's called PDV Holding. It's a Delaware corporation that owns Citgo. So they have actually been served with this $1.4 billion writ of attachment, as they call it. So they have to pay now.
The problem is that neither cash-strapped Venezuela nor its national oil company have the money to pay the debt. But with 3 big oil refineries, oil terminals, and pipelines, Citgo is worth many times that $1.4 billion, and other debtors and possible buyers are now lining up. If Citgo ends up being sold off in total or in parts, experts say the day-to-day operation of the company is likely not at risk, at least not for long. Most of its management team is in Houston. The gas stations are all independently owned and not at risk either. CNBC reached out to Citgo for comment, but did not hear back in time for this broadcast. The question is, what happens to Venezuela, who sells a lot of its oil back to its own company, Citgo, if it loses control? Russ Dolan said the country has other buyers, but may lose something the Maduro regime needs more than anything else right now: cash.
They do rely heavily on the U.S. market, but there are other companies in the U.S. Actually, Citgo is not even the largest purchaser of Venezuelan oil in the United States, although Citgo runs around 750,000 barrels a day through its 3 main refineries. Venezuela actually sends more oil to companies like PBF in the U.S., but it is their most ready source of cash.
Paper money is all but worthless in Venezuela. So if Venezuela ends up losing Citgo, it may also lose a big buyer of its oil. The case is complex and often confusing, likely to all but a small group of attorneys. But the bottom line is this: unless Citgo's parent company, PDV Holdings, gets a last-minute legal miracle or can somehow find up the money to pay that $1.4 billion debt to Crystalex, it is likely that Citgo's run as a valuable part of a nearly failed state will come to an end. For Nightly Business Report, I'm Brian Sullivan.
Still ahead, soupy sales. Campbell Soup says it's making big changes to its business, but the jury is out on whether that will work. The Trump administration is canceling pay raises for civilian federal workers. In a letter to congressional leaders, the president said the government must, quote, maintain efforts to put our nation on a fiscally sustainable course, end quote. An increase of about 2% was set to go into effect in January.
Well, it's a familiar story these days, and sometimes distressingly so. An iconic American brand loses its way, and today it was Campbell Soup's turn. The company reported weaker than expected quarterly revenue and said that it plans to sell some divisions in an effort to refocus the company. Now, that sent the stock lower in trading today, but can Campbell move forward by scaling back? Sarah Eisen takes a look.
Campbell Soup, the 146-year-old company, is trying to reinvent itself. Today, announcing it's putting its international and fresh businesses up for sale. That would be brands like Bolthouse Farms, Garden Fresh, Arnott's Biscuits, and Kelsen brands. The company also left open the possibility for a full sale of what's left over. So what is left? Soups and snacks mainly. We're talking brands like Campbell's Own Soups, Snyder's Pretzels, Pepperidge Farm Goldfish, Milano Cookies, Kettle Chips, and more. The upshot? Wall Street isn't impressed.
To the company's point, they are lapping some very difficult periods last year where they lost some big promotions at Walmart. So there's nothing like easy comps to get your numbers looking in the right direction. But we do believe that their long-term outlook that they reinforced in some lines today and actually raised in other lines today is too aggressive. We were a little bit surprised that they didn't take that outlook down a little bit. We think the company will be hard-pressed to reach 1% to 2% organic top line long-term.
Campbell's businesses aren't doing particularly well, even worse than the overall tough packaged food industry right now. Organic sales for the latest quarter shrinking 2%, soup sales declining 14%. And it's not painting an optimistic picture of future growth either, with an outlook of just 1% to 2% organic growth. The company did host a long 90-minute conference call with analysts today, where interim CEO Keith McLaughlin did say the company lost focus and depended too much on mergers and acquisitions. McLaughlin says all options are in play going forward, which does leave the door open for a sale. We know that's what activist shareholder Third Point and Dan Loeb have reportedly been pushing for. Two big questions: who would buy it, and can Campbell's be attractive again and turn around its core business? That is very much unclear, and many analysts are skeptical. For Nightly Business Report, I'm Sarah Eisen in New York.
Sales shine at Signet Jewelers, and that's where we begin tonight's market focus. After reporting a surprise increase in same-store sales, which was driven by strength in the jewelry retailer's Zales brand, the company raised its full-year forecast. Signet's quarterly profit was also ahead of expectations. The sales soared 23% to $67.68. The discount retail chain Dollar Tree said a rise in sales at its namesake brand was offset by higher costs and flat growth at its Family Dollar division. Overall, the company delivered earnings and revenue in line with estimates, but margins shrunk, and Dollar Tree said it was trimming its full-year earnings outlook. Stock dropped 15% to $79.78. Its rival, Dollar General, fared better this quarter. Same-store sales at the discount retailer accelerated more than expected, and profits topped estimates. The company did note that margins were pressured by an increase in sales for low-margin items. Dollar General also lifted its sales guidance for the year. Shares were off nearly 1% to 105.66.
Abercrombie & Fitch missed same-store sales estimates, hurt by weak demand for its Hollister and its namesake A&F brands. The clothing retailer did, however, deliver a surprise profit, but that did nothing for the stock. Shares plunged 17% to $22.55. Consumers were buying up Lululemon products. The retailer reported strong store sales growth and earnings that blew past estimates. Shares initially took off in after hours, but they finished the regular day down 1% to $137 even. Watch this one tomorrow.
Many market watchers had called for a breakout in the bank stocks since the Fed is hiking interest rates and the economy is humming right along. But the sector is lagging the broader market so far this year. But is that about to change? Marty Mosby is the director of bank and equity strategies at Vining Sparks. He joins us now to talk about that. Marty, good to see you. Welcome.
Thanks for having me.
You know, the banks had a weak 2016 and a weak 2017. And they are lagging the broader market, but is it really a bad news case for the banks?
Well, it's not. We need to recalibrate a little bit of what you said. The banks lagged early on in both 2016 and 2017 to rebound in the second half of the year and outperform in both of those years. And I think we have a similar pattern this year where we're going to lag in the first half of the year, but by the back end of the year, we're going to see the banks and the improvement in profitability bleed into the stock prices again.
There are banks, and then there are banks. There are big ones. There are super regionals. There are little ones. Which sector of this vast environment do you think is poised for the greatest profit growth and stock market performance?
Well, when you look at the banks that can benefit the most from where we're at in the rate cycle, as well as deregulation and deployment of capital, it's really those super regional banks. It's the SunTrust, Regions. It's even like Citizens Financial Group or Fifth Third. These are all banks that have, various different strategies, but the environment is positive and they get the most pickup from what they're being able to benefit from incrementally over the next 6 to 12 months.
Marty, there's, of course, those rising interest rate environments, which has been helpful to the banks, but we're also seeing a slowdown in mortgage originations, and that's important to a number of different banks out there. Does that worry you at all?
Well, again, the mortgage industry is a little more sensitive because house payments are such a big portion of a household's budget to these higher interest rates. And mortgage rates have rounded up a full percentage point since rates started to go higher. When we look at the general, kind of business environment, we're seeing consumers on credit cards, other areas growing some of their lending. And we see businesses, small businesses are finally getting into the act here. So we are seeing some benefit from those small business lending aspects as well. So there's other parts of the economy that I think can do better than what we're seeing in the mortgages right now.
All right, Marty, thank you very much. Marty Mosby with Vining Sparks.
And coming up, why Santa Monica is ground zero in the battle over motorized scooters. California's state assembly passed a bill that would require publicly traded companies in the state to have at least one woman on the board. The state Senate is expected to approve it as well. The legislation calls for creating an extra board seat to accommodate a new female member instead of removing a male already on the board. The governor has not taken a position on the issue.
In some cities, scooters are seemingly everywhere. That is especially true of Santa Monica, where they are flooding the streets and apparently cluttering up the sidewalks. And now cities are moving aggressively to control the rapid growth. Aditi Roy has the details tonight.
Santa Monica is on the front lines of the scooter wars. Companies like Bird and Lime dropped the devices on the city a few months ago without warning or permission.
I think it's a great idea. I cannot stand electric scooters.
They're an absolute menace.
Santa Monica is trying to bring some order to the chaos, announcing today that Bird, Lime, Lyft, and Jump have been awarded permits to operate under a pilot program for electric scooters and bikes starting next month.
Uber and Lyft, you have no point in being here.
Earlier this month, Bird and Lime staged a day without a scooter protest after a city committee recommended only Uber and Lyft as its top choices for the pilot program. The companies are fighting for a critical piece of the pie in a rapidly growing industry. In the last 3 months alone, Bird has grown from operating in 5 to 6 cities to 40 cities. Commuters like Josh Burstein say at $1 to rent plus 15 cents per minute thereafter, scooters are a cheaper and more convenient alternative to cars or public transportation.
It's perfect for going like half a mile to a mile.
But the backlash against scooters, noted in images of scooters littered across city streets and public spaces, could have a significant business impact. Cities are taking action. D.C. and Dallas have put in place regulations on scooters. Scooter regulations are also pending in San Francisco, Los Angeles, and Miami. The regulations include helmet requirements and lowering the speed limit, which could force firms to make costly hardware changes and lose customers.
Bird is among the scooter companies now working with regulators by handing out free helmets. As far as the cost of such programs, they say it's already baked into their business forecasts. For a Nightly Business Report, I'm Aditi Roy, Santa Monica.
Well, we've been talking a lot lately about softening demand in housing, in part because prices have skyrocketed. It's also true on the very high end of the market, where we're seeing some of the biggest price cuts. Robert Frank explains.
From Johnny Carson's former Malibu estate to Warren Buffett's beach house and Dick Cavett Hampton's hideaway, some of the priciest real estate in the country just got a little less pricey. With the luxury real estate market under pressure, price cuts are getting steeper and far more common. An analysis by CNBC and Redfin found that at the top of the real estate market, those are homes listed for $10 million or more, 12% of listings had discounts in the second quarter. That's twice the level of 2016. Price cuts totaled more than $1 billion for the 500 biggest discounts during the quarter. For example, The Ziff estate in Manalapan, Florida, was originally listed for $195 million. The price dropped to $165 million last year, and it just dropped again to $138 million, a total price cut of $57 million. The late Johnny Carson's estate in Malibu, which has stunning views of the Pacific, got a price chop of $16 million, now listed at $65 million. And Dick Cavett's Hamptons Digs got a price cut of $13.5 million this week. It is now listed for $48.5. But the biggest price cut of the past 12 months was this $250 million house listed in 2017. The price cut, $62 million. Even Warren Buffett is lowering his prices. A beach house in Laguna, California that he had listed for $11 million has just been reduced by $3 million. But he's still likely to make Buffett-sized profits. He bought the home for $150,000 in the 1970s. Some of these original prices were pure fantasy and designed to attract attention and had to come down. But the market for trophy properties is also falling from oversupply, a lack of foreign buyers, and tax changes that hurt high-tax states. With prices still high at the top, brokers say the billionaire bargains are likely to get even bigger this fall. For Nightly Business Report, I'm Robert Frank.
Before we go, let's take a look at the final day on Wall Street and the numbers. The Dow Jones Industrial Average dropped 137 points. The Nasdaq fell 21 and the S&P 500 was off by 12. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everybody. And we'll see you right back here tomorrow.